I have to ask you about AI and NVIDIA and all of that. Is there any common thread or any valid comparison between the AI boom that's happening right now and, say, the internet bubble of the late 1990s and early 2000s?
There are a lot of parallels. When I started doing wireless, there were 34 million cell phones. Today, there's 7 billion. So it's a hyper-growth industry that grew almost in parallel with internet, because without mobile, you wouldn't really have the internet that we have today. In the early stages of that growth, so when you look at penetration, Wall Street always underestimates the importance of the technology. And part of it has to do with it's a generational lens. Every new technology is adopted by a young cohort, people in their 20s. Teens or even 30s, but most people on Wall Street are in their 40s or 50s. So they're one generation removed. I remembered when our PC analyst at Kidder said, why would you have one computer per household, or even more than that, because they're $2,500. And I know when cell phones first emerged, people thought it was a yuppie toy and it was going to be only for people who make $75,000 a year. But what I learned as a wireless analyst was teenagers and young kids, especially in Europe, were using cell phones. So I used a vintage model saying that if 100% of teenagers have a cell phone, by the time they're 60, the penetration rate should be whatever it is. That's like AI. The adoption rate for AI is staggering, but the use case is important because there's a labor shortage. So to me, I think it's very likely we're underestimating how much revenue all these companies will make. I can give you some simple math.
Yeah, please.
The global labor shortage by the end of this decade is close to 40 million worker equivalents. And that's 3 trillion of wages.
Okay.
We're turning labor cost to tech automation, of which we know today 80% is hardware or silicon. So does that mean whoever's supplying the chips might have a 2 trillion revenue? Probably. And right now, the largest share of that would go to a company like NVIDIA. So if NVIDIA is $100 billion in revenues now, what is, by the end of this decade, is it $800 billion, a $1 trillion revenue company? And then what should we discount that rate at? I'd say there's probably a lot of upside.
Just from an overall index perspective, there is an incredible lot riding on a handful of companies right now, whether it's NVIDIA specifically, the Mag 7 more broadly, and that, in 1999, there was just an incredible weight on Cisco and Sun Microsystems and Microsoft and a couple of others. Do you see any parallels in the market environment?
Yes, there's a lot of parallels, but there are some differences. Keep in mind Cisco sold a $100 box. NVIDIA is selling a $50,000 chip. So the moat around that is much, much greater. I also think to contextualize this, we need to look at the global economy.
Yeah. If
we're turning labor cost into silicon, then which countries are really the primary suppliers of technology? The U.S., by a country mile, is the only supplier. So the U.S. is essentially exporting technology now. And that's different because internet was more democratized. People just put up towers and laid fiber. You can't, create your own version of an NVIDIA chip. You have to buy it from NVIDIA. So I think that tech will probably be, 40, 50% of the global stock market weight.
Where are we now?
That's probably 20.
Wow.
It's probably like 18. I mean, in the U.S. it's only 40.
And when in the U.S. it's 40, globally it's 18, and you say it's going to go to 40 to 50% globally.
Yes, because you're replacing recurring labor costs with a capital investment.
Talk to us about rates, the higher interest rate environment, and what it means for stock valuation. Because I think this is where people are either a little bit surprised or perhaps a little bit nervous. The idea that even in the higher rate environment, stocks can move upwards.
Yeah, well, again, I can cite some history and then maybe provide some context.
Please.
But since 1935, when you look at the relationship between the 10-year yield and forward PE, it is not linear. It is a dynamic relationship. And between 4 and 7%, it is positively correlated. So when interest rates go up, PE rises. Logically, it sort of makes sense because you're seeing it now. When you have higher rates, it's barriers to entry. So the existing companies make more money and companies earn money on their cash. So unlevered companies are actually, for Apple, it's like $6, $7, $8 in earnings, right? Some big number. Actually, with splits, it's lower. And between 4 and 5%, the median forward PE has been 18.5. And 48% of the time, it's actually above 20.
What's S&P trading at now?
Well, the
PE?
The forward PE is probably around 18.
Okay.
But the median forward PE is 16.
What should we make of the fact that a lot of the market is not doing well?
I think it speaks to a lot of things. One is the market is starved for cash. I mean, there's $6 trillion cash on the sidelines. FINRA margin debt is like 20% below where it was in October 2021. So there isn't a lot of money sloshing in the stock market. I know it's weird because we're at record highs.
Yeah.
So if there is money actively trading, it's just buying the high volume sectors, which is tech. From a rates perspective, and I kind of mentioned it before, like the groups that are hurt by tight policy have really been sucking wind. So I think if monetary policy eases or people are more convinced of it, then breadth expansion is going to be pretty fierce later this year.
What is your outlook for rates at this point? Because you mentioned the strong consumer earlier, but on the other hand, we have seen a little bit of weakening in the labor market. We have seen CPI start to soften, although there's a lot of debate over whether or not that's going to be a durable trend. But what are you seeing?
Well, I think inflation, if we looked at historically how people looked at inflation, whether it's the surveys or ISMs, inflation's under control. Because like, for instance, the ISM services manufacturing, the prices paid component is below the long-term average right now. So at 57, people think 57 means price going up. That's not true. It's averaged like 58 since inception. So actually price trends are below where they have been. I think people aren't using history to understand where we are now. And if you look at UMich surveys, both 1 year and 5 year inflation expectations are below the long-term average. So consumers and businesses in their perception don't think there's inflation. CPI is elevated, but as you guys know and talked about, and many economists point out, it's really due to two components that are kind of lagging, right? One's shelter and one is auto insurance. And you know, the median CPI inflation rate right now is 1.4% year over year. Its long-term average is 1.6. Everything except for housing and auto insurance is below trend. There's 137 components. Another way to look at it is what percentage of the basket of CPI equal weight is below their long-term year-over-year growth rate. So take each component and just say, where does it sit? It's now at 55%. So and the long-term average is 50. So more than 55% of CPI components are below their long-term average. It's considered controlled when it's 50%.
Do you have a year-end target for the market or a 1 year target or anything like that right now? Like, where can we go?
Well, on the first week of December 2023, we had said our target for 2024 was 5,200, which at the time was almost 20% upside. Now our 5,200 is low because we're above that level.
Yeah.
We haven't changed our target because our practice is typically to do it at the mid-year.
Okay.
So we're 2 weeks away.
Can you give us a little hint?
Yeah, I'd say originally we said earnings could be 270.
Okay.
And we'd put like an 18 multiple on that. And that's got you to 5,200. 2025 earnings no longer look like 270. It looks more like 285.
Okay.
And as I was citing, as interest rates moved up, the PE should be higher. So let's say 20 is a more appropriate PE multiple, or even 21. Then you get into the 5,800-ish level. But I think the open question is really, if you're in mid-June and December 31, is it a line up or is there a pullback and then a line up? And I would probably, this is not evidence-based, just an opinion. I don't see why it would be straight up.
Here's something I always wanted to ask an equity strategist, but when you're coming up with the price targets, do the specific numbers actually matter for your clients, or are they mostly interested in the direction, the overall direction, like line go up, line go down?
Well, do you know, this is a lifelong debate because for 30 years, I covered wireless stocks and I had price targets. And our salespeople would always say, no one cares about your price target. But then the first thing in the meeting, people are like, what do you think? Where do you think this thing goes? So they always care about the price target. I don't really value people's price targets, which is 10% above where you are now. Because to me, that's like staying in the middle of the lane and you can't make clients money. So whenever we did stock research, we always had to build a base case on what we think could happen and then discount it at what we think is a reasonable rate. A lot of our price targets seemed really crazy when we did wireless. I remember I upgraded, you can timestamp it, I actually show you, Alamosa Holdings at 21 cents and it went to $22. My price target was not 30 cents. It was $12 at the time. And we upgraded Western Wireless at $1.74. Our price target was $25, and it ended up going to 40. So I think we try to look at a normalized situation, and in a normalized world, if this is a normal S&P cycle, okay, following demographics, I could provide a chart later. S&P should be potentially 15,000 by the end of the decade. Yeah, so to me, that's the more, as you move into longer time frames, that's probably where I think we're moving towards.
All right, guys, this is the part of the video where I'm going to break down the stocks that were mentioned in the Tom Lee interview. Today, they just talked about the overall economy, the SPY, the QQQ, and then they talked about NVIDIA, since it's on a once-in-a-lifetime AI trend right now. So we'll briefly break down all three of those. If this is your first video, the blue line is the 45-day moving average and the green line is the 200-day moving average. So right off the bat, you can see there is a distance that we have between the 45-day. We're almost 3% off the 45-day moving average and almost 12% off the 200-day moving average. So we are creating a pretty decent gap above these moving averages, guys, which could be a sign for a pullback like here. When we had a pretty decent gap, we started to top out and come back and break through it. The bullish case would be to hold this 542 area and break out past the 550, keep making new all-time highs. The bearish case that I can see is that we push all the way back up to 550, we make a double top here and then start rejecting lower. That could bring us back down to the 535 area to the 525 area, which would also be right around that 45-day moving average. If we check out the QQQ, this is all the tech stocks. It's a little bit stronger, a little bit farther off the moving averages. So it's almost 4.5% off the 45-day moving average and almost 14% from the 200-day moving average. So those are some pretty big gaps to pay attention to. These ETFs could start getting a little top heavy after this massive run. You can see we come back and touch this 45-day moving average all of the time. As of right now, if we were headed back to the 45-day moving average, we would have to drop at least 3%. You can see, guys, worst case scenario, we do come back and touch the 200-day moving average. We will remain bullish as long as we hold this 473 area on the QQQ. Ideally, we'll keep going higher and break out of this 487 and make new all-time highs. The bearish case will start getting rejected somewhere around here. We could have this first leg down, cool off period, and then another leg down. That would bring us back around the 460 area, right at that 45-day moving average, which again would not be the end of the trend. It could just be a nice healthy pullback to then keep going higher. Stocks can't just go straight up forever. They do need pullbacks. But until we break this low, we are bullish and we should keep going higher. Now NVIDIA, everybody's baby. The last week has been crazy. We dropped about 16% in 3 days, but now we spent the last 2 days making almost 9% back. So this stock is moving crazy, down 16%, up 9%. If you ask me, we're still looking a little bearish. This kind of looks like a shoulder. This could be the head. We can make another shoulder right now and come back down to this 45-day moving average around 110. But as long as we hold this 118 area and keep going to the high side, we are looking bullish. I just think we're a little top heavy. I think we're going to start getting rejected and going lower even before we get up to $130 per share. And I think we'll make our way back down. As always, I hope you guys enjoyed the video and the breakdown. Make sure and hit that like button and subscribe if you haven't already. And I'll catch you in the next video. Peace.